Taxonomy regulation, which provides uniform criteria for companies and investors to determine whether an economic activity is environmentally sustainable. The EU taxonomy came into force on 12 July 2020, although mandatory reporting in accordance with the EU taxonomy will not be required until the 1st of January 2022 at the earliest. At first glance, the EU taxonomy's scope may appear relatively narrow, but it's of vital importance to the energy industry, and it will have a wide-ranging impact. Simon Ovenden in our capital markets group will give a brief introduction into EU taxonomy regulation, and then Marianne Anton in our London projects group will lead a discussion with our panel of experts made up of Gustavo Brianza, Managing Director, ESG Advisory and Debt Advisory at NatWest, Henry Morgan, Sustainable Investment Manager at Foresight Group, and Paul Stuart-Smith, Executive Director at Zero Carbon Finance and Chief Strategist at JS Global. But some housekeeping points before we start. First of all, please note that participant video and audio have been disabled to minimize interruptions. Please also note that if you'd like to pose a question or comment to any of our presenters, please use the Q&A function, and we'll either reply during the Q&A session or at the end of the webinar. Alternatively, you can contact the speakers directly following the event. And finally, please note that the webinar will be recorded. Thank you for joining, and I hope you find the session useful.
Well, good morning, everyone, and thank you for joining. We thought we'd start by giving a brief presentation on the taxonomy. Some of you may be very familiar with it. For some others, it may be relatively new. So we thought it would be helpful just to spend 10 minutes trying to set out what we think is the purpose and the impact of this new regulation. So if we can start going through the slides. I've got a colleague in charge of the slides, so I don't mess up. So, so what's it all about? Well, it's a sort of classification system and a reporting system. So it's going to be a tool that's going to be used, I think, in a number of different ways as people understand it and get to grips with what it means for them. And fundamentally, I think, you know, it's obviously designed to encourage sustainable investment, and in particular to create a classification system that is consistent, is easily understood, and allows people to avoid sort of fragmentation and in particular greenwashing. So people saying that they're doing things that are sustainable when based on a consistent sort of benchmark that applies across industries, that one's able to identify whether or not it really is a sustainable investment. And so to increase transparency, visibility, and just create a consistent framework that will be obviously be deployed in the EU, but hopefully will have a sort of broader impact as well. And then there are other ways in which it will also probably come into play, for example, in prudential supervision and reporting. And there is some discussion that actually, in terms of things like capital adequacy treatment, it may become an element in how those calculations are made, although that's not yet in force. But it gives an idea that this regulation is likely to have enormous impact across, you know, quite a wide range of different entities who become subject to it. So if we look at that and we could go on to the next slide. So who does it apply to? Well, it applies to financial market participants who are operating in the EU, and FMPs, you know, is a pretty broad universe of people, including investment funds, pension funds, financial institutions. You know, it's very broad, and it's also going to apply to issuers as well, in respect of financial products and corporate bonds that are made available as environmentally sustainable. And those regulations are not yet fully formed, but I think what it will mean is that if a company wants to do a sustainability-linked bond or a green bond, as well as thinking about ICMA principles and other things, there will be a taxonomy benchmark which will need to be considered in disclosure around that bond or financial product. And it will also impact on large public interest entities. So those are companies that have securities listed on regulated markets in the EU, they're subject to the non-financial reporting directive, and that will tie in with the taxonomy. And that's a sort of a general thing, that the taxonomy will actually tie in with a number of other reporting obligations, disclosure directive, the NFRD, and so on. So it's going to impact a lot of people. If we go on to the next slide, so what's it all about? It's about setting benchmarks as to what activities are deemed to be environmentally sustainable pursuant to taxonomy. And there are 4 criteria for that, which should be popping up on your screen now, I think. There we go. So to be environmentally sustainable, you have to track through these 4 criteria. It's got to contribute to the 6 environmental objectives, and we'll come on to those in a moment. And it mustn't significantly harm the 6 environmental objectives. And this concept of doing no significant harm, the DNSH, is a very important pillar of the taxonomy that we will be discussing in detail later on in this webinar. It's got to comply with certain minimum safeguards that are set out in the regulation and comply with the technical screening criteria. So just to put a bit of flesh on the bones of what we're talking about there, if we go to the next slide, please. So we've got 6 environmental objectives, and we look at each of those in turn, but if we perhaps just populate the screen, we'll bring them up. So we've got climate change mitigation, climate change adaptation, sustainable use of water, marine resources, transition to a circular economy, pollution prevention and control, and protection and restoration of ecosystems. So 6 pretty broad environmental objectives that create the framework, the benchmark against which we determine environmental sustainable measurement. If we go on to the next slide. And in creating those 6 tests, obviously it's involved quite a lot of work in creating the technical screening criteria, and we'll look at that now if we just populate the slide again. So we've got uniform criteria for economic activities within 13 sectors, and that's broken down industry by industry, whether it's energy, agriculture, transportation. Some sectors are not yet covered. There's a long discussion around nuclear energy that's ongoing, and for aviation as well, we're expecting to see some specific criteria. But for those that are in place now, those criteria will be used to determine whether the economic activities contribute to the environmental objectives and can be considered sustainable. So it's a binary test. Obviously, your business can meet those thresholds or not. You also need to look at that do not cause significant harm test as well, and that's very important. And as I said earlier, we'll be talking about that in a bit more detail as part of the discussion. And then we have delegated acts. We have a taxonomy regulation, which is actually quite a short piece of legislation. The devil is in the detail in the delegated acts. And the 2 first delegated acts for climate change adaptation and climate change mitigation have now been published and come into force 1st of January, but we aren't able to consider those in some detail because the letter of the law is in place. And then for the following 4 objectives, we are awaiting those detailed delegated acts with the relevant supporting information as to how you meet those tests. So turning to the next slide. As I said, we've got an expert group that has created the tests and the measurements of environmentally sustainable. There's obviously been a lot of discussion around this. The EU had a consultation back in December, and they got 46,000 responses to that consultation, which in my experience is a record number. There's clearly a lot of debate about whether the taxonomy is fit for purpose, and we'll be talking about that obviously as we go through our webinar. But as it stands, there has been a very long and considered attempt to establish criteria based on, technical input from experts for each sector that is under consideration. Moving along. In terms of how these regulations and how these annexes and so on play into reporting obligations, we've got the disclosure regulation, which came into force in March, and we had the non-financial reporting directive. So taking that one first, reporting companies, those large listed companies, will need to include information in their non-financial information statement to the extent to which they comply through turnover and capex and opex in aligning with the taxonomy regulation. And then FMPs, as I said earlier, asset managers, pension providers, financial advisors, will need to report how and the extent to which their portfolios align with the taxonomy objectives. And there's some real important criteria there in terms of the portfolios, what percentage is aligned, and how they meet the DNSH test. Now, of course, you could just say, well, our products do not meet the EU taxonomy. In practice, particularly with the current impetus for ESG reporting, clearly that's not going to be something that's going to stand any asset manager or pension provider in good standing with its clients and its investors. So, there's going to be a significant change in the way that information is provided on portfolios in order to comply with the regulation, which in turn feeds into the disclosure regulation. Turning to the next slide. Who is this actually going to affect? Well, anybody who's offering financial products in the EU is going to need to comply with these disclosure obligations. And it's also for large public entities subject to NFRD, it's going to apply to their activities wherever they're located. So you might have a large company that is headquartered in Paris, listed on Euronext, but has significant manufacturing businesses or other operations in the Far East or the Middle East. It will need to satisfy the reporting obligations under regulation in respect of those operations it has which are outside the EU. Clearly, Brexit means that the UK will follow a slightly different path, although the EU taxonomy regulation was enforced before Brexit and so becomes part of UK law. The subsequent annexes and delegated regulations do not form part of UK law, and there is a new UK Green Technical Advisory Group, which is a technical expert group, is looking at what to do in the UK. And perhaps that's the time to sort of mention that clearly we have an EU taxonomy, an EU framework. We've got to be mindful of the other impetuses out there, obviously with the UN Sustainable Development Goals, the Task Force on Climate-Related Disclosure, and initiatives in Asia as well to create reporting obligations which are ESG related. So there will be some degree to which we'll all be grappling with how those regulations all play for multinationals that may have multiple reporting obligations in different jurisdictions. Hopefully they will be to a large degree aligned, but there may be contradictions and other ways in which they don't quite all sort of fit together. So that's something people would also need to be working through. So I think that was the last slide, and I hopefully in the brief time I've had, that's just set the scene for the discussion. I'll hand it back to Marianne now.
Thanks very much, Simon, for giving us that overview. I think we will just have our panelists introduce themselves briefly before we start. And I'd like each of you, please, to just set out your approach to and your interest in the EU taxonomy, and a little bit about why you're here with us today. So if we have Gustavo introduce himself first, followed by Henry and then Paul.
Hi, everyone. Thank you, Marianne. Yeah, my name is Gustavo Brianza. I'm responsible for the ESG advisory team in NatWest for corporates. I've been doing advisory work with corporates for the last 20 years or so. And obviously, there are having a lot of dialogue with corporates, and with banks and investors on what the taxonomy means for them, how to implement the reporting requirements, how to link this to financing, and green use of proceeds financing in particular. So that is my interest in everyone here. Thank you.
Hi all. Name's Henry Morgan, Sustainable Investment Manager at Foresight Group. Essentially, it's my role there to ensure that there's a best practice approach to sustainability, is integrated throughout investment, asset management, reporting and fundraising processes. Worth noting that on the infrastructure side, Foresight very much sees itself as a sustainability-led infrastructure investor, actively targeting investments that make a demonstrable contribution to the global sustainability agenda. I think sort of our interest in the taxonomy comes from a couple of years ago, ESG ratings agencies were becoming sort of more prevalent, as were sustainability accounting standards, but we felt that there wasn't really, those standards weren't really acknowledging the more holistic contribution to global sustainability that sort of our investments had baked into them. Based on that, theoretically, and I don't mean to vilify coal power, but a coal-fired power station could theoretically have a better environmental rating than a wind farm, simply because of the processes and policies that it had in place. So that's why I think Foresight has been so happy to see the EU taxonomy come through, where it does demonstrate an appreciation of that holistic contribution to sustainability. And the perspective I hope to provide throughout today is that of an organisation that has found real utility in practical implementation of the taxonomy, both as a due diligence tool to verify investment decisions, and also as a mechanism for certifying an asset's contribution to that global sustainability agenda.
Thanks, Henry. And finally, over to you, Paul.
Thank you, Marianne, and good morning, everyone. And thank you also to Watson, Farley and Williams for inviting me to be part of this discussion today. So I'm involved with two consulting businesses, Zero Carbon Finance and JS Global, and we advise companies across sectors on sustainability strategy and a broad range of other ESG and green finance issues, including implementing the TCFD recommendations and other reporting frameworks. And we're also now getting involved in the financing of zero carbon projects. And I'm sure that as the EU taxonomy begins to take effect, that will also be a part of our work going forward.
Great, thank you very much, everyone. I think we will just dive into our questions. As Henry Stuart mentioned at the beginning, if you do have questions while we are carrying on the discussion, please do submit them in the Q&A. And for the time being, we're just going to jump straight in. So I am going to start with an easy one, which is around the multiple reporting standards that Simon mentioned. In particular, in November last year, the government published a roadmap towards mandatory climate-related disclosures that covers the period over the next 5 years, and that's going to be aligned with the TCFD recommendations. So I guess a question for everyone is, how does the EU taxonomy fit in with this and the other reporting frameworks? Perhaps we could go to Paul to start, and then the others can join.
Thank you, Marianne. It's a great question, but not necessarily an easy one. The fact is, there are so many different reporting standards and frameworks that it can sometimes be hard to keep track, and certainly hard for companies to know which framework they should be using in their corporate disclosures. And it can, of course, also be hard to keep track of the whole alphabet soup of acronyms which are commonly used to identify the various standards and frameworks in this space. And so I apologize in advance for using quite a few of them in what I'm about to say. Simon has already given us an excellent overview of the taxonomy, and in his presentation, he also mentioned the Sustainable Finance Disclosure Regulation, the SFDR. These pieces of legislation form two of the key pillars of the EU Action Plan on Sustainable Finance. And there is a third pillar, the newly proposed Corporate Sustainability Reporting Directive, or CSRD. For those of you who haven't come across the CSRD yet, the draft was only published in April alongside the EU Taxonomy Delegated Act, which Simon described. And the basic idea behind the CSRD is to build on and strengthen the disclosure requirements of the Non-Financial Reporting Directive, the NFRD, which the EU now considers are not sufficiently robust, and also to extend those reporting requirements to most small and medium-sized firms, or SMEs, in due course. So while the SFDR governs how financial market participants should disclose sustainability information to end investors, the CSRD aims to ensure that companies report the information those financial market participants need in order to fulfill their reporting requirements under the SFDR. Still with me so far, I hope. In any case, one of the things that the EU is trying to accomplish with these three pieces of legislation is to harmonize the various, mostly voluntary, sustainability reporting frameworks which have proliferated over the past 20 years or more, arguably beginning with the publication of the first version of the GRI guidelines by the Global Reporting Initiative in the year 2000. Now, the preamble to this new proposed directive, the CSRD, also specifically references the frameworks provided by the Sustainability Accounting Standards Board, SASB, the International Integrated Reporting Council, the IARC, the Climate Disclosure Standards Board, CDSB, as well as CDP, and the recent proposals of the International Financial Reporting Standards, the IFRS Foundation, to create a new Sustainability Standards Board. So I certainly hope that the EU will succeed in making it easier for companies to understand what they need to do in terms of sustainability reporting, but also that by placing disclosure standards on a legal footing, that it will raise the bar on the quality and authenticity of the information that is reported. Now, in your question, Marianne, you asked specifically about the recommendations of the Task Force on Climate-Related Financial Disclosures, or TCFD for short. Very briefly, this task force, as many of you will know, is not an EU or a UK creation, but was set up in December 2015 alongside the signing of the Paris Agreement by the Financial Stability Board, the organization of the world's leading central banks, because of their concern about the risks climate change posed to the stability of the financial system. The task force issued its recommendations in June 2017, essentially providing a voluntary framework for companies, financial and non-financial, to use to assess the risks and opportunities to their businesses from climate change, and then disclose information about these risks and opportunities to their investors and other stakeholders in their annual reports. And as Marianne indicated in her question, the UK government is in the process of shifting TCFD-aligned disclosure from being voluntary to being mandatory. Now, in the EU, the TCFD recommendations were explicitly added to the reporting guidelines that underpin the NFRD in 2019. But these guidelines are non-binding. So one of the things the new CSRD is intended to do is to also make TCFD-aligned climate reporting mandatory in the EU. So to return to the EU taxonomy, by defining which activities can be considered to support the economic objectives of the environmental objectives of climate change mitigation and adaptation, that taxonomy should help companies involved in these economic activities to identify and demonstrate their resilience to climate change. And this can then be brought out in their TCFD-aligned disclosures. However, the taxonomy does not cover activities which are not green, that is to say, brown. So for many sectors of the economy, the taxonomy is not directly relevant, and that is one of several criticisms that have been made of the taxonomy itself. The other point I would like to make in relation to this is that a key element of TCFD-aligned disclosures involves carrying out scenario analysis, and I don't think the taxonomy is particularly relevant to that process at this stage. I think I'm going to finish there. I was going to make a reference to the question of whether the EU taxonomy is applicable in the UK, but I think Simon's already covered that one. So let me stop there for now.
Well, that was very comprehensive, Paul. Thank you. So I think if I can just summarize some of what you said there, it sounds like when something like the TCFD becomes mandatory in the UK, the taxonomy will be able to be reporting under the taxonomy will tick part of the boxes for that, but there will still be a lot more for companies to do to meet the TCFD requirements. So it's not going to be, or rather, the EU taxonomy will be part of that as well, part of the TCFD reporting.
I think that's right. And I think the other important point, though, is that the taxonomy is going to work in conjunction with those other two pieces of legislation, the SFDR and the new non-financial reporting directive, if you like, which is the CSDR, or the CSRD rather.
Oh, that was very comprehensive. I was going to give everyone else a chance to chip in, but I don't know whether you've got anything else to add. That has covered that, sir.
I was just going to say, yeah, I mean, that was a super comprehensive answer and just really well portrayed and really well broken down. I think it's just sort of to kind of bring it back, I'd really like to sort of just re-emphasize the point that it's important to see the taxonomy for what it is, which is a tool to help channel money towards business activities that contribute meaningfully to global sustainability. And I think it does that by incorporating some of the most material issues that other reporting standards, such as TCFD, seek to address. And I think as an example of that, I think in the recent Delegated Act, there's been a significant increase in what they're asking people to report under the taxonomy in terms of exposure to climate change, physical risk. So it is basically, I suppose it's just worth noting that it does act as a bit of a summary document to incorporate some of those most material concerns from other reporting directives. But as was mentioned, I think, you know, the fact that it does only focus on those activities that are sort of truly green, and there will be activities that will need to report under all those other reporting frameworks that won't really be able to do any kind of won't be able to report under the taxonomy simply because they're boxed out of the list of activities that are detailed within it. Yeah, I think just while some may say other frameworks are kind of more detailed, at present they're only really used on an optional basis, and I think that's really important to bring back to the point that actually alongside SFDR, the EU taxonomy, the two of them, they're the first two of all of these that have actually been brought into regulation. So while the others might be more detailed and might give you a more granular look at certain aspects, actually these ones are the only ones that are in regulation at the moment, which I think adds gravity and adds weight to them.
Great, thank you very much for that. And while we are speaking with you, Henry, we might just pick up on Foresight's infrastructure funds. Some of them have publicly committed to compliance with EU taxonomy, and they've engaged a third party to provide an independent assessment of compliance. Could you tell us a bit about how that process has worked, and how you resolved any interpretation issues around specific criteria?
Yeah, sure. I mean, so I think I've alluded to it previously, but I mean, the world of sustainable investing and ESG investing, it often comes up against the issue of greenwashing. The word's already been mentioned once or twice today. And that's, you know, where organizations are accused of essentially trying to make an inherently non-green asset look green through the reporting of some or a few or a singular positive characteristic that aren't really connected to their kind of core business activity. And I think with that, I think the whole purpose behind using a sort of third party to validate our approach and to validate our assets was really kind of a means of ensuring two things. One, that we ourselves at Foresight weren't falling into the trap of believing our own hype and greenwashing our own assets, because, you know, you're in your own echo chamber at your own company, and, you know, you think you're doing the absolute best, but using the external validator was a way of kind of checking ourselves and mitigating that. And also the fact that we just saw there being real value in having somebody external make that honest and transparent appraisal when it came to engaging with external counterparties as well. So, you know, be it potential or existing investors, having somebody else say that this asset is green rather than us say it, we saw there being kind of real merit in that. So that's kind of what guided the approach towards how we approach the sort of taxonomy for one particular fund that I'm thinking of. The process was relatively simple in that we sort of looked for reputable organizations that were both familiar with our area of investment, which primarily renewables, which is the bulk of our infrastructure portfolio. And we also needed those organizations to have a familiarity with the EU taxonomy, which at sort of this point last year was still something relatively new and people were still sort of grappling with. So there were a few organizations out there, and we just put a tender out and say, this is what we want. We would like an asset level taxonomy validation report. You know, what can you do? And I think while a lot of people approached the process through doing internal review of their portfolios and assessing percentage alignment of that portfolio, again, as has been mentioned already, assessing percentage alignment of that portfolio with the taxonomy in order to say, great, our portfolio is 80% aligned or whatever else. We were very keen for one of our flagship funds called Foresight Energy Infrastructure Partners. It was at the point of first close last year. It was very much targeting assets related to the energy transition. And we were very keen for that fund to be one of the first 100% externally validated EU taxonomy compliant funds, i.e., can it be rubber stamped by the EU as sustainable investment through and through 100% of all assets? So that's why we kind of took, the timings work well, we took the asset by asset approach. And our engagement with the external party, we didn't want to be overly involved with them. And it really revolved mainly around providing key pieces of information to them from our due diligence materials, and then connecting them to the right internal staff and external counterparties. And then realistically, just giving them a little bit of free rein to scrutinize the various aspects of the project and hold them up against the technical screening criteria, which have already been mentioned. And it was down to them to express an opinion as to whether the assets that we had were either compliant with the taxonomy or not. So did they have that rubber stamp of a sustainable investment or did they not? And if there was a sort of lack of detail within the taxonomy on how certain parts were to be approached, a lack of detail back then about how do you approach the do no significant harm assessment, or how do you approach considerations of circular economy, etc. There wasn't a strict handbook as to how to sort of implement the taxonomy. So realistically, it was down to them. They had free rein, and as long as they were transparent in how they approached that assessment, then that was fine. And that is what they put into their final report, and that is what we shared with our investors. And that's resounded really well with our investors. I think the investors take great confidence in the fact that there is this external validation report that we can hold up and that they can hold up to their underlying investors and say, you know what, this has gone through a process of review by an external party, not just the investment manager. And it's been found to be fully on board and fully sort of in line with the EU taxonomy. And I suppose that's kind of how the process rolled out.
You brought up a couple of really interesting points there, and on the interpretation issues, we will come back to that later in discussion. But before we get to that, Foresight Group is a large group. You invest in a lot of, you've got certain funds that invest in a lot of renewable energy companies. I think an interesting point to draw out here is that many companies that work in this space may not be directly caught by the reporting requirements of the taxonomy themselves, but it is likely that their investors, whether they're institutional investors or traditional financiers, will be caught. So for energy companies specifically working in certain areas, there are technical screening criteria that are set out for energy. And those criteria documents are rather hefty. And there are relevant criteria for them that are also set out in the manufacturing and in the construction and real estate sections. So I've got a few questions around this, but if we turn first to Simon, could you tell us a bit about what activities these criteria apply to, just to give us a sense of the range?
Yes, so I mentioned earlier that we've got 13 different sort of sectors. I won't list them all, but I've obviously got the document to hand. It's just to give people a flavour. The two annexes which I mentioned earlier as coming into force for climate change adaptation and climate change mitigation, they each run to about 190 pages. So it's quite a lot of detail, but it covers, as we said, 13 industries: forestry, it covers energy, certain manufacturing industries, aluminium, iron, steel, chlorine, some chemicals, and then obviously generation of energy, which is really covering a broad range, photovoltaic, solar power, wind power, bioenergy, and geothermal energy, and so on. You've got transportation, which, as I said, does not cover aviation yet, but covers certain elements of water and freight rail transport. You've got construction, obviously a very big one, construction of real estate, new buildings, renovation of existing buildings, and some others as well. But those are the sort of primary ones, as well as I should actually mention water collection, treatment, and supply systems. So it covers a broad range. And whilst on the one hand you might think, well, I'm just running a sort of solar power business, I just need to look at that sort of relevant section 4.4 or whatever it is. You clearly got to think about the life cycle of what you're doing. You're making something, you're procuring equipment to make your things, and of course once you've got your things spinning around, you're trying to obviously find a way to transmit the power through to the end users. So there is a more holistic way you've got to look at it, and obviously you can see that depending on what you're doing, you can be caught by a number of the different elements of the taxonomy.
That's actually the perfect setup for my next question, which I'm going to direct probably to Paul and then Gustavo, which is about how usable the taxonomy is for non-financial organizations. If you would start on that for us, Paul.
So shall I go, Marianne?
Please, yes.
Okay, yeah, and I'll be brief, so Gustavo can have a chance to speak as well, of course. So I'll take 1 minute perhaps, but I mean, just to be clear, so the requirement on non-financial firms to disclose information is set out in Article 8 of the taxonomy, and under Article 8 they're required to report what share of turnover, capex, and opex are associated with environmentally sustainable activities as defined in the taxonomy. In terms of how usable it is, and that's, from my perspective at least, I think the jury's still very much out. For one thing, the Delegated or the draft Delegated Act, which sets out the detailed rules for Article 8, was only published on May 7th, and is still going through a period of public consultation with the aim of being adopted by the end of June and then being implemented alongside the rest of the taxonomy at the start of next year, but on a phased-in basis. In any case, as the taxonomy has been developed over the past 3 years, it has been the subject of a lot of focus in financial circles, but very little attention has been paid to it by firms in other sectors of the economy. And this seems to be borne out by a straw poll I carried out in the past week or so of contacts and clients at FTSE 100 and FTSE 250 companies. And the non-scientific result of that survey is that it is still very early days. And most of the people I spoke to are still very much focused on other reporting frameworks, such as TCFD, for example. Why don't I just leave it there and hand over to Gustavo?
Well, thank you, Paul. I think, yeah, I mean, I would totally agree with what you're saying. From the perspective of what I've seen, it is again early days for most corporates, but in a lot of discussions with large corporates, they are really focusing on now how to implement it. And it's not just an issue of how usable it is, but it is that it will be required reporting, right? So companies will have to go through this, right? In the 1st of Jan in 22. It's going to be larger companies, so 500 employees or more. But as Paul mentioned before, when the Corporate Sustainability Reporting Directive comes to force, which I would expect it will be a lot more companies. So it'll go from about 10,000 companies that have to report to about 50,000 that have to report with 250 employees or more. So that's quite material, right? And that may sound simple, share of revenues that are aligned to the taxonomy, share of capex, share of opex, but at the same time, the corporates that have gone through this, and there has been a focus a little bit more on the energy side of things, renewable energy, and regulated distribution transmission companies have been focusing quite a lot on their own reporting requirements, more than other, let's say, manufacturing, for example, for the time being. But those companies have gone through some very in-depth exercises, because this needs to be an activity by activity, very granular assessment, right, of what share of revenues is aligned to that taxonomy. So going back to this, I think it will be quite useful to many of these companies, because even though it is very exacting, it's a difficult exercise because it's granular, it's bottom up, right? And the definitions for each activity in the delegated acts and the annexes are incredibly technical, right? So they capture information both on climate mitigation as well as adaptation, which corporates do not usually capture, right? So most companies are not used to capturing these technical data on pollution, on CO2 generation is the bigger picture, but you're thinking about other very exacting standards on things like circular economy, for example, right? And so it'll allow these companies to start capturing this, right? Which will help in a couple of ways. One, it's required, as I said before, right? So you'll have to report it if you're a corporate of a certain size. Secondly, all of your capital providers are really focusing on this as well, and they have to do their own reporting, as you mentioned, Marianne, before. So we can talk about banks in a little bit, but banks certainly are sending questionnaires to companies. Unfortunately, they're all different questionnaires, right? So the taxonomy, and obviously corporates have difficulty filling these things. The taxonomy hopefully sets a bottom line of information that the corporates need to provide to their banks, right? So it'll be helpful in that way, in the sense of attracting capital for activities which are robustly defined as sustainable, right? Because that's the whole point of the taxonomy, is to have a robust, granular, technical, scientific definition of what is a sustainable activity. And thirdly, I think in the supply chain, so if I'm a corporate supplying to somebody and buying from somebody else, from another company, the supply chain providers are increasingly focused on this as well, right? So they will require information on greenness of activities and greenness of revenues, let's say. So the last one is that most of the large companies also have their own net zero pledges, right? And so they need to track how they are getting to this and which activities are investing in to get to this net zero pledge. And obviously, this is, again, a robust and exacting standard for them to start measuring how they're making investments, particularly with respect to adaptation, right? So mitigation, but also adaptation in the next 5 years, let's say, to get to their own net zero pledges. So I think, in short, or in summary, let's say, it's quite useful in various contexts, but it will be a painful exercise for most large and small corporates.
Just one other thought on that, if I may, and really, to underpin what Gustavo was saying about the fact that the technical screening criteria are very detailed and very explicit, and so in that sense they should be quite user friendly for non-financial firms. But where I can perhaps see the complexity coming in is for companies to decide from an accounting perspective where precisely to draw the boundary on the turnover, capex and opex numbers between the green activities and the non-green activities which are involved in. But that's something perhaps for CFOs to figure out, and not my problem.
I think we'll switch focus slightly, but we will stick with you, Gustavo, and just ask about how lenders are looking at compliance with the taxonomy. You mentioned that they're sending out questionnaires, but what else are they doing? How are they thinking about this?
Yeah, so I can start on the European Banking Authority. Obviously has proposed. I think it's from end 2022 that banks start reporting their green asset ratios, so-called. Now that is for all of their loans and exposures, and also assets that they hold, so securities that they hold for the time being. And so that is again another reporting requirement, right, that banks will have, and therefore the questionnaires, etc. Right. So the GAR, the green asset ratio, so the proportion of assets that the bank holds that are green, are defined and aligned to the taxonomy definitions, right? And so the technical screening criteria as well, right? So this becomes very important when you're thinking about certain activities. So for example, if you're lending into renewable energy, that's pretty clear, right? As long as you meet the technical screening criteria standards, that's pretty clear that will go in the right bucket, right? When it comes to the GAR, green asset ratio. But when it comes, the great majority of banks do a lot of, not non-project specific lending, right? So to a corporate, right? And there you also have to look at the proportion, again, the proportion of revenues of your borrower that are aligned to the taxonomy. Now, the technical difficulty with this is that if you think about one corporate, right, that does maybe you know, of these 70 activities that are currently covered, maybe they cover 20, right? That's a quite important exercise for the corporate to do to assign what proportion of their revenues are aligned to the taxonomy. The bank has to do this for every single, you know,
That's Gustavo's frozen, I think.
Yeah, Gustavo's frozen. So I think he was saying that the banks have to do that for every single borrower. But we will we'll let him give him a moment to try and dial back in. I think that was it's very good, detailed responses there about how banks are approaching this, and it's a I think one of the points that we should take note of there is that the bank does have to do it for every borrower. So banks will probably play a role in helping corporates draw out the information that they need to in order to comply. We have our next question.
Hi, Gustavo.
I'm sorry. The joy of
we just sort of we wrapped that up a bit for you, Gustavo. Thank you. We've actually had we've had a question come in on the Q&A, which is related to one of the topics we were about to discuss anyway, which is about Thomas Engelman, the head of energy transition at KGAL Investments, has asked, is there an auditing behind the reporting? And if yes, who is auditing the taxonomy reporting for financial asset managers? It's a very, very good question. And it ties very neatly into one of the things we were thinking about in preparing this webinar for you, which is around the criteria. So many of the criteria center around do no significant harm assessment. The Delegated Acts set out in Appendix 1 Annex A set out generic criteria for DNSH, and they refer to things like best practice, robust assessment, an assessment that is proportionate to the scale of the activity and the expected lifespan. So we've got a number of questions here around, what does it actually mean in practice, and who assesses whether these criteria are met? And what happens if you do disagree with someone's assessment? So clearly this ties in very, very neatly with the question we've had in from Thomas. Simon, do you want to start us off, please?
Sure, yeah. Well, I think, and perhaps just to sort of set a scenario, the Delegated Act really covers both very precise requirements and then these generic requirements. So, and maybe just to give some context to that. So, taking one example, if you talk about the requirements for electricity generating for geothermal energy, in order to meet technical screening criteria, you need to look at a number of different things. So the first thing is substantial contribution to climate change mitigation. And there's a very precise threshold set in the annex, which is for life cycle GHG emissions, must be lower than 100 grams of CO per kilowatt hour. And they must be calculated using specific recommendations set out in EU legislation, ISO classifications, and they must be verified by an independent third party. So it's very much a bright line test. And that's one example. In terms of the DNSH test, still looking at that relevant industry sector, it then says, well, you need to comply with the criteria set out in the appendices A and B. So for climate change adaptation, you look to the generic criteria for do no significant harm. And that is a test that is less specific, shall we say, and involves an assessment and a judgment, because you need to perform what is described in the legislation as a robust climate risk and vulnerability assessment with a number of specified steps, screening the activity, looking at specific physical climate risks as are also set out in the appendix, assessment of sort of adaptation solutions. So that is clearly something that still involves significant expertise, and clearly in making those judgments about have we identified the right risks, have we assessed the risks correctly, have we come up with the right assessment of the right solutions, you're still going to be relying on some benchmarks, not just your own sort of, oh, I made it up yesterday sort of idea of what I think is right. And there is some guidance in the annex, for example, talking about assessment reports published by the IPCC, which for those of you who don't know what that is the Intergovernmental Panel on Climate Change, which is the UN body. So there's I would say that it comprises elements of a great specificity, the 100 grams of CO2, but then also sort of generic criteria where there is a framework sort of set. But I will defer to others. I mean, particularly, Henry, I guess you sort of had a look at that and all around that with your independent experts to sort of come up with something you thought was justifiable, would meet a challenge, as it were, that you'd adopt it on a reasonable basis.
Yeah, I think that talks back to the point I mentioned about, where there isn't necessarily the greatest level of clarity or a greatest level of specific sort of detail around how that is to be assessed. It is just down to the independent validator to be transparent about the approach with which they made that assessment. I suppose I would give an example of an assessment that we had done on a wind farm, talking about the do no significant harm in respect of the other 5 environmental objectives, looking at the circular economy thing, where in the present day there is a known issue that the composite materials used to create wind turbine blades are largely they're a straight to landfill type item. So current wind farms that are being decommissioned at the moment, there's a bit of a head scratcher over what to do with them. However, the assessment that was made was looking at the trajectory of increase of recycling technologies for wind turbine blades, looking at the life, the sort of life cycle and the length and the asset duration. So 25 years out, 25 years times the level of increase of technologies of how that kind of material can be reused, recycled, and how it can be integrated into that circular economy. And that's how the assessment was made, that it was still compliant with that transition to a circular economy. So it's, again, it's the detail wasn't necessarily there in the taxonomy, but a view was taken. And again, I think, like I said, the most important, to answer the question, that there wasn't any sort of, there is no at present official audit of this. But again, being transparent and honest in how that assessment has been made, I feel is probably the most important thing that you can do at this point in time, so that you can demonstrate to your stakeholders how you've approached that issue and how you've arrived at the conclusion that you're still compliant with the taxonomy. I hope that's helpful.
No, that makes sense to me. And I think, in defense of this whole framework of regulation, it is new and it's going to take people some time to understand what it means for their business. And also, I think for independent experts and assessors to also say, well, we're looking at a specific industry. These are the sort of things that we think are relevant in terms of the generic criteria, based on due consideration and so on. And I think you will then establish reasonable benchmarks, because naturally any thoughtful companies can say, well, what are other sectors, other companies in my sector doing? I want to be sort of best practice, and if large organizations are following a specific methodology for that generic criteria, that will, I think, set some sort of benchmark as it all sort of beds down. I think it will something that will develop over time, and obviously will be to some degree specific to different industries.
So, in summary, watch this space, I guess, for the auditing that will come. I think that sort of we're coming at the issue of greenwashing, which we've mentioned a couple of times already. And of course, part of the whole aim of the EU taxonomy was to avoid greenwashing. I guess if we, I know we've all got some thoughts on this, but we'll probably turn to Paul first. And the question is, do you think that this will be achieved, or are we set up with the taxonomy to get there?
Well, this is, of course, a key issue. And I hope very much that the taxonomy represents a watershed, not just in terms of reducing greenwashing, but in terms of transforming the whole ESG investment landscape. At present, companies can score well on ESG metrics without contributing at all to any environmental objectives. And this has allowed the explosion we've seen over the past couple of years in ESG labeled assets under management without any material improvement in environmental outcomes. So having to meet the requirements of the technical screening criteria in the taxonomy in order to qualify as green, and the disclosure standards in the SFDR and the CSRD should make greenwashing more difficult, and also allow us to distinguish between those companies and those investments which are actually making a positive contribution from those which are merely skilled at, if I may use this expression, putting lipstick on a pig or rearranging the deck chairs. So two things that could, or specific things that could help to improve transparency of reporting, I think, are standardization, which should make it easier to compare disclosures between firms, and assurance, which Henry's already alluded to several times in his comments, assurance of the sustainability information that companies report, which is something that is proposed under the CSRD. So it won't just be up to companies to tell you whatever they want. They will be required to get assurance on that. Probably, I would think, from some of the big, accounting firms like PwC and so on, who do that sort of work anyway. But just to finish off, the big questions for me are: what approach will the regulators take to enforcing the rules on the taxonomy? What penalties might they impose for non-compliance? And what remedies can or will the courts provide in the event of litigation to sue for breach or misuse of the taxonomy?
Great. I think we probably have a lot to say on that one, but we have had a question in from an anonymous attendee, which is probably a good way to wrap up this session, because we only have a few minutes left. Can you provide a brief summary about what we should be doing now as FMPs in terms of disclosure?
Well, quickly, I could take that. There's a sort of long answer and a short answer, but I think a lot of the regulation is now in force. Came in March 2021. And some of it will start to apply from 1st of January 2022. But you really got to focus on three areas: website disclosure, pre-contractual disclosure, and periodic reporting to investors in the context of the taxonomy. I mean, I don't think there's a short answer other than to say you need to be aware of it, and it's going to, I think, be a significant exercise again for FMPs to put in place systems and procedures to be able to report. But I think, coming back to Paul's point about regulation and penalty and so on, those are all obviously absolutely fair questions. I think there will, to some degree, the penalty will be, if you don't think about the taxonomy, a lot of FMPs will not be interested in dealing with businesses that don't embrace it, because FMPs will be mindful of their own reporting obligations and their own thresholds of percentages of taxonomy compliant, investments they want to make.
Thank you very much for that, Simon. We are right nearing the end, and I think that's all we have time for today, because I really would like to finish up on time and let you all get on with your days. I'd like to thank all of our panelists for joining us today, and thank you to the audience and submitting your questions. If you do have any further questions, please do feel free to get in touch with us directly, and we can follow that up with you. And just a final couple of housekeeping points. If you dialed into the webinar, please do email events@wfw.com so we know that you attended. And everyone who has attended will receive a follow-up email that includes a short feedback survey. Your feedback is very important to us to make sure we're delivering events that are relevant and engaging for you, and sort of making sure that we make the best use of your time. So thank you again to all of our panelists. Thank you for joining us, and we will no doubt speak again soon.
Great, thank you very much.
If there are any unanswered questions from the Q&A, we'll obviously try and answer them as well after the webinar. Not leave people hanging.
Great, thank you very much.
Thank you.
Thanks all.